Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, April 30th, 2020. What I'll do in this video is sort of a potpourri, a mix of a little bit of everything. Look at the charts. I always say I won't take it too long. I will try to keep this one under 30 minutes, but just we'll hit on the charts quick. Not a lot of, no reason to spend a lot of time here on the index charts. I gave you this morning, put out a post with these magenta lines, pretty much the what I think right now are the most important levels to watch. You have SPY, QQQ, and some of the others. I'll run through those real quick. So there's SPY, there's our uptrend line. QQQ, we have a comparable uptrend line right here. Just have that brief dip below. But as I said in that post today and recently, you need to see, not just one index break, not just one sector break. The more you see break, the higher the chance you're going to get that sell signal to stick. So nothing's changed in the technicals, technical posture of the charts. Let's see why that's not an hourly chart. There we go. Now it's an hourly chart. There's that trend line right there, and you could see it on QQQ daily as well. And then the big sector ETFs, XLK, tech being probably the well, not being probably, it's certainly the most important sector, as I often say, and have for years. When tech breaks, the market breaks. So that's it. So we had whipsaws the other day. And I did post quite a few responses to the comments under last night's post. I'm still trying to catch up on all those. And what I'm going to do today is hit on some of the answers or the questions that were brought up there, whether I replied to them or not. And again, one of them is, I mentioned that this is peak earnings week. So not only do you have the market-leading FANG stocks reporting this week, which make up the bulk of the net, or not the bulk, but a very heavy weighting in the S&P 500, and they're also top-weighted components in the Nasdaq 100. You have just about, not every other company, but I think it's over a quarter or more of the components of the S&P 500 report this week. So big earnings week. As the economic calendar is as heavy as I've ever seen it, with GDP, Fed meeting, just numerous market moving reports. And so what I had said in the comments section, and one of those comments is, I've been apt to suspend. I was considering suspending all stops this week. I'm going to get to that in a second, because we had Autodesk. We had one trade hit a price target yesterday and one get stopped out. I'll go over those in a second here. But that's it. I'm watching these big sectors. And what I had said in that post is, the more of these levels go, the more likely you are to see a sell signal that sticks. Whereas I'm seeing the comments on the homepage, a lot of people, think I'm stubbornly hanging on to the SPY short. Look, I don't manage this site for popularity. I manage, I'm putting out what I'm doing as a trader. I've traded in these markets, and I always say this: trade. Use stops, take trades that fit your comfort level, your trading style, and pass on those that don't. So if you're not comfortable with suspending stops, let's talk about SPY real quick. When I did that yesterday, I looked at where we were yesterday, and so basically I've changed by allowing a little more room on this stop above the original max suggested stop of a daily close above 286. Yesterday it put us about 2%, right at about 2% above that stop, and it's still to that point from where we entered. That gives us a 2-to-1 risk-reward ratio, meaning we're risking $1 of loss to make $2 of profit if that fourth target's hit. And should we roll over, as I still suspect we will, we very well may add, and almost certainly if we get anywhere close to T4, in other words, if we get down to start to approach T3, I will probably extend targets, because I do think we'll, at the very minimum, come in for a near test or near undercut of those previous lows back there. And so when you look at it from a risk-reward perspective there, it's better than a 3-to-1. And so again, to me, this is just how I trade. That's SPY. That's what is that? About a 7% drawdown on that trade. Looking for, from again where we entered on this one, potential easily of 20% or more. I'll take that all day long. I'm happy with this way that this trade has planned out, but again, there's not enough in the charts that have changed. That's the most important thing here. For the comments that I'm stubbornly sticking with a trade, hell bent. And most importantly, it's just one of many trades. That's the big thing here. If you're trading all your money right now in your portfolio, whatever, on the indexes, then you have a concentrated trade, and you yeah, you're probably feeling a lot of pain. It's not being offset by other trades that should be profitable. All right, so that's it. And most importantly, nothing technically has changed. We're in an uptrend. We continue to inch higher. We did take out that recent multi 3-week trading range, but it doesn't seem very impulsively so far. We moved up, back tested, had this pop up, and again, it's earnings week. It's heavy economic calendar. So I'd really be curious to see how we finish the day tomorrow, Friday, because we have Amazon and Apple. Those are two of only 3 companies in the U.S. That are $1 trillion or more in market cap. The only other one that has $1 trillion plus market cap is Microsoft, and they reported last night. So we'll go over that. So again, do as you want on these trades, but as of now, and I may even pull this stop again tonight, depending on how we close today. We're down now, but it's nothing big, 0.75. So we'll see. I'll look at the final hour trading, and like I said, we have 2 more to report, and then we'll go from there. And let's look at those 2 real quick, since I set up kind of be all over the place. Here's Apple. Apple has this very clean, and again, this is a common theme here that I'm seeing. We're walking above these trend lines. We have a nice, in many stocks, many sectors, many indexes, very clean, well-defined uptrend lines off those lows, and the same story. Now, Apple was not diverging, unlike some others. We did not have a divergent high until just recent, until right here. You can see now we have this wedge type pattern, very clear and clean negative divergence. Of course, the stock needs to turn these indicators down to confirm that divergence. So what I think are the likely scenarios for Apple, earnings are always a crapshoot, but you can see some well-defined support levels right here. 302.24, very well-defined. So while the earnings can go either way, they can go down right after they report, and then the conference call, whatever they say or don't say. A lot of companies are holding off on giving guidance, but I can easily see a pop up here to 302.24. In fact, I'd almost favor it. I'm not going to trade it. I'm not going to gamble on on what happens in earnings, but that is a very well-defined resistance level, 302.24. So I could see a pop and drop. That's about a 4% pop. Next level above there is about 312. Because these levels do work. In fact, let's see, it was Alphabet reported recently, and you had on the daily chart, you go back to the prior videos, I have not modified any of these lines. I had this line here when I covered this one with the FANG stocks, and several of the videos recently. That's at 1335.91. You can see where this stock popped up to after earnings, right to that level, had a brief overshoot, closed right about on that resistance level, and then failed. So this is the common theme that we're seeing here, and this is actually the trading pattern for Alphabet. If you notice, they rally up into earnings. This was last earnings date back here in February. Little pop after that, put in a divergent high, and then after earnings, drop down. Back here, this was an earnings pop right here. This was, I believe, an earnings pop. So you get these rallies into earnings on these stocks, and then they often fade right after that. So far, they haven't faded the entire pop, not nearly, because there was a big gap, but there's no follow through. It gapped up right into resistance, and so far has stalled out there. Let's look at some of the other ones, see what they've done too. Facebook, obviously strong today, big beneficiary. A lot of people staying home, and you can kind of see the same thing here on Facebook. Some of the previous earnings marked up, rallied up to the earnings, big gap up, and then they faded it, and that was it. The stock didn't stop falling until it hit here. And you can go back in time and see that a lot of these, if I put horizontal lines, see there earnings are every 3 months apart. So you go back here 3 months, you had earnings there. That one was actually, we were selling down into earnings. So I guess the takeaway, guys, I don't know exactly where it was. I'm just kind of eyeballing 3 months prior. But the earnings tend to be inflection points for a lot of these stocks. That was most likely the earnings right there, rallied up to it and then dropped. This one I happen to have it written here, April 24th, so that would be right there too. All right, so you get the pattern of this stuff. If you have a stock that has an extended rally up into earnings, these companies almost always blow it out of the water. They're big growth companies, but then that tends to be more all of and then some of the positive earnings reports are usually priced in. So only time will tell, but that is the typical pattern. Again, you get these run-ups into earnings, you get a big pop, big gap up. That's what that happened right there. If you look really close, you can see it. This little that's an island top right there. I talk about those a lot. You have a candle separated by a gap on both sides, and they are major topping candles. So should we gap down tomorrow? What could cause that? Well, so far, the initial, again, just initial reaction to earnings on the first three fangs have been positive, but let's say that Apple or Amazon aren't so much, or whatever happens, they get faded. So you could look for that there. And it doesn't have to be an island top. It could be any other type of reversal pattern there, but that's it. Facebook, a lot of resistance up there. So I think that's it. Microsoft, you go right here. So far up today, but giving back a lot of last night's gains. Oh, some of the other things I wanted to mention as we go through these market-leading FANG stocks are these high-level bearish PPO crossovers. I highlighted these before. Right there, you had a bearish PPO crossover. And when I say a high level, look for clean separation in the lines. One way to see it better is put up a histogram on the PPO. If you don't have a PPO, use a MACD. So you get these, when it goes from green to red, that's when you have a crossover. And by what you want to look for is clean separation. And you can, by that I mean a pretty good distance. You can see a distinct distance. This is not right here. You have very low volatility. That's a slow grind. So what happens is the PPO is flat. You can't really see. So you're going to get whipsaws. When it's flat, it's going to cross above and below. Stay away from using trend indicators like that. Where you want to use them are these clean hills. When you have clean separation, what I call hills right here. There's a hill. There's your crossover. Boom. This was a bullish cross right here. As you guys know, I was bullish back here. We had long trades on the side off the lows, and this confirmed a lot of these PPOs made bullish crossover, low level, clean separation, what I call clean crossovers, and so that's something we're going to watch for. You can almost anticipate them. They're not guaranteed, but when you start to see these histograms dropping off sharply, that's because that PPO line's turning down, meaning yeah, we're in a rally, but the momentum is slowing. That's that 3+ week sideways trading range I've been talking about in the market. So that's it right there. We'll watch. We don't have those crossovers yet, but just let's look at a few of the bigger names. Here's Apple. Not yet there. We'll see what happens after earnings. Again, Amazon also tonight. Any downside after Amazon reports is going to give us that bearish PPO very clean after the biggest hill in a while. There was our biggest, hill to the downside, and there was our bullish crossover there. There was our biggest hill for a long time there, and our bearish crossover. So these are the things I'm looking for. And again, this is all about, these are momentum indicators. And it's just saying, yeah, the trend is up, and we're not going down. And I think that's where people often mistake, a runaway rally for, a market that refuses to drop. For one that's also really not going up much anymore, a lot of stocks. So we'll watch that. And again, you can replicate these on your own charts, go back in time, look for these, look for these big hills, and then avoid the trend indicators like this and histograms when you get the, choppy sideways trading ranges like that. Okay, and then keep it in line with kind of the big picture thing. So much of my analysis recently and over time is spent looking at intraday charts, 60-minute charts. But every now and then I like to just zoom back to the big picture and talk about what the big picture is, and that is where we're at in the cycle of things. So somebody on that last night's, and again, I'm trying to address the comments from last night's end of day closing post. Talked about IWM, just how bullish it is, and the comments below that or in that thread was something to the effect we should be long IWM. It looks more like bull market behavior than bear market behavior early stage, so implying there's a lot more upside. So let's just talk about that. All right, let's just zoom in here a little tighter. This is IWM. This is a weekly chart. Yeah, this big bearish rising wedge. The small caps are in a bear market. And let me just say that one more time. The small caps are in a bear market. Small caps have been in a bear market now for years. They topped back in 2018, August of 2018. It was a big bearish rising wedge pattern. Yes, these same rising wedges that work on the 60-minute charts also work just as well on weekly, even monthly charts. It broke down. It wasn't just a questionable breakdown. It's like I like to say, you want to see a solid break, impulsive selling, everything you want to see, and that started the bear market, and that's the bear market we're in now. It started here. You had an initial wave down, a kickback rally that failed before the previous highs, and another leg down. Now, where we're at right now, we have retraced since that was the top of the bull market right there and started the bear, and we retraced so far. We stalled out here at the 50%. Now let's talk about this week's rally, because this is what I talked about almost over a month ago when we were still on the way down, saying, look, we're going to get a bear market rally. When the next bear market rally comes, just before it ends, you're going to want to be long. You're going to think you're in a bull market. You're going to say this is just too convincing to be a bear market rally. That's the nature of bear market rallies. Again, I may be wrong. You know, there's no guarantees in all this, but let's talk about the action in a bear market rally. This week has been very strong in IWM, although we're starting to give some. So look at this candlestick, big green candle at one point from the close of the previous week. Remember, today's only Thursday too, and so this was through yesterday's highs right there, 12%. Right? I'm grabbing the top of last week's candle. That's where we closed. So wow, what an impressive rally! But look technically what it did. We just came in to backfill a gap. I have the Fibonacci levels. We stalled out, ran into the 50 slightly, had a slight momentum fueled overshoot, and stalled out there. Again, that's a 50% retracement of the bear market drop so far. We can even move that line. True Fibonacci, technician might want to look at that previous high that we fell short. Still same story, because it was so close to the other one. We failed. In other words, we have yet to even retrace 61.8. And if we do, that's actually very good resistance. That's around the top of the gap right there. See, so as much as IWM has rallied, it can easily, from where we're at right now, in my opinion, rally another 10% or so. That's about 9%, almost. No, let me get right up to the line. Yeah, call it 9%, and still very, very, very much be considered or be in the realm of a typical bear market rally. All right, now what we're going to do is go back in time a little bit and look at the last bear market. Okay, so I just showed you so far we've retraced 50%, and again, those comment was, a rally that strong, small caps are up so much, that can only be bull market action. Well, all right, let's look at the last bear market, okay? And I'm going to zoom in just a little bit tighter there so you can see it. This is it. We topped right here. I put a Fibonacci line at the end of the last bull market on IWM back in 2007. There was our first there's our first big bear market rally right here. We zigzagged down and had a very powerful bear market rally. We retraced almost to the button, 78.6. I removed the 58 and 38 fibs just to not clutter this up. So again, let me reiterate, this bear market so far, IWM has only retraced 50%. Last bear market, it retraced that 78.6% fib right there. And look what it did that week. That was a very powerful week. Had a huge lift on the small caps. Went as high from the following week, about 10%, 9% right there. And then look, reversed intra-week. That's when you get this long, the skinny part there. It's called a shadow. The shadow is the skinny part on the top or the bottom. But when it's on the top, you call that a wick. On the bottom, a tail. The fat part's the body. So that means at some point during the week we were that high, and then we closed the week right here. And so that's a big intra-week reversal. When you see that long shadow up top, that's what that was. And again, so I just wanted to put out the point that as much as we've rallied now, we could continue to rally and still, even if we get to that 61.8, we've still retraced less than that first big, major bear market rally back then. So again, we all have our different opinions where the market's going to go. We'll all be either right or wrong, but right now I struggle to find anything in the charts that say this isn't just right now a bear market rally. I also talked about, I want to mention this too, in that post. Somebody asked a question, hey, what would the level be on SPY where the bearish case isn't is done? And my answer, and kind of maybe not these words, was it was pretty much there's not any one level. It's not so simple to say, well, if we cross, XXX level, we flip from bearish to bullish. We certainly chip away, but right now, all the divergences, and we're still walking up precariously close to those trend lines with the divergences still intact. So the same bearish case that was made a week, 2 weeks ago is still there today, if not more bearish, because the divergences have only extended, and I've gone over that before. Typically, you put in these series of divergent highs, of little corrections along the way. As long as those divergences stay intact, then it typically indicates a big trend reversal is coming, and the bigger the divergences, usually the bigger the reversal. Now, if the divergences are burned out in the 60-minute time frame, we go through and one by one, sector after sector after index, then yeah, it certainly chips away at the case. But I talked about this in as far as the scheme of where this rally is going. Again, I already put in perspective, and I've covered this with SPY and QQQ, Fibonacci. SPY really QQQ is not a balance. It's not a diversified index. It's really a tech fund or a tech index. So, the S&P 500, Dow is a good one to use. S&P is the best, I believe. Small caps, mid caps, and again, those are right now in the realm of nothing more than a bear market rally. Whether that proves to be not whether we have a V recovery or not. So far, it's just been a snapback rally. But I talked about this. This is important to note that that this rally could carry beyond those levels. It could even carry to come close to or test or even go above the previous highs, because right now, at no other point in time, we had a lot of Fed intervention back in 2008, but the Fed, what they're doing now doesn't even measure up. They came in on magnitude of order higher with the everything they've done, the amount of money that they're injecting into the system, what they're doing, they outright buying ETFs, buying things like the LQD, corporate bond ETFs, buying junk bonds, things that they normally don't do. And so what's going on here is the whole price discovery process is being distorted. I don't want to sound like grim and doom and gloom. I'm really not. I don't want to be the bear blog, but I'm a firm believer that just like in the natural world, and you start messing with Mother Nature, changing things around, same in the financial markets. When you have gross distortion of the price discovery process, which is basically it's a process of determining price of an asset in the marketplace, so a stock, the index, the stock market itself, oil price, whatever it is, those prices are determined between interactions of buyers and sellers, all known variables. But right now, and that's the natural price discovery. And it's never in recent years, it's never a perfect process because you have all kinds of speculators. But right now, you have the Fed coming in and not hiding it. They are overtly distorting the price discovery process. They are masking, huge losses, which should be huge losses, and what were on corporate bonds, junk bonds, investment grade bonds, ETFs, and of course stock prices as well. Here's and I get what they're trying to do. They're trying to kind of bridge loan the economy right now, trying to get these companies. They almost had no choice. Like I said it before, guys. Remember on the way down, I kept saying if we go much lower, the financial system will break. And it already has started to break. We already saw oil go negative and other things. There's been a lot of cracks. But they did plug up. They took a lot of fingers, I think as many fingers as they have, and plugged up the holes in the dam and kept it from breaking for now. And that's a good thing. Like I said, I did not want to see the financial system completely break as much as it would have been profitable. But I told you back then before we bottomed, I was done shorting. The risk reward was not good enough. It just was not favorable. Not that I would have profited from complete and utter collapse in the financial system. It wouldn't work anyways. The brokers would shut down. They would ban short selling. Brokers would collapse. Interactive Brokers is already had a big hit when oil went negative, things like that. So I just want to mention here, this is important. Read up and learn about that. Then the other thing I talked about is somebody, and again, I'm just kind of flying off on different tangents. Somebody mentioned we're following in the footsteps of Japan. And yeah, I encourage you to read this. I put a link under one of the comments there, The Lost Decade in Japan. And they really refer to it as 2 lost decades, or lost 20 years, because that's what it was. And if you read about it, we're following on their playbook back from the early 90s, where they had an asset price bubble, real estate, stock market, everything else, and that bubble collapsed, and they did everything that the Fed is doing, quantitative easing, zero interest rate policy, and the Fed is hailed as a hero because they, in 2008 it happened. But again, remember 2008, they only started that halfway down. The market topped in 2007. We were already well into a bear market. They started firing all their big guns back in 2008, but the market kept going. And what happened is it hit a level where prices were just so dirt cheap. In the recession, they didn't allow it. They tried to stop it, but too late. And the recession ran its course, which was a good thing. You need to have recessions. It purges out excesses in the economy. So I don't give credit to the Fed saving. The markets dropped 55% back and from 2007 to 2009. They came in, a little late to the game, but there was still more downside from when they started in that bear market. And now what they're doing is they're coming in early on, and that's what's scary. And you look, here's the Nikkei. This is Nikkei 225. That's Japan's index. I put up a chart in there. I took off log scale just for dramatic effect to show you what it looked like. This is when you take off, and this is why I like to use log scaling. There's also often questions and comments on the site why people's charts look different from mine. I use log scaling. When you don't, it distorts the prices, but that's what it looks like without log scaling. When you put log scaling on, what log scaling does, it just makes the chart show you the moves in equal percentage terms, not dollar terms. Why? Because when you have a $100 index or stock, let's say, and it goes up $10, how much did you make on the stock? You made 1%, right? You buy a $10 stock and it goes up, or no, let me go back and just say this. You have a $100 stock or index that goes up 1 point or $1, that's a 1% move. When you have a $10 stock and it goes up $1, that's a 10% move. That's a huge difference, and that's why you don't want to use non-log, especially on long-term charts, because the log scale will tell you that if you go from 100 to 1,000, that's comparable. You went up 10 times. Same thing as going from 1,000 to 10,000. So, or 10,000 to 100,000. So that's it. But with that being said, what happened? Did zero interest rates and quantitative easing save their market? No. Again, this is 1 decade, 2 decades later, they were still lower. Finally, after 2 decades, they went up. So I think we're a little bit behind this curve there, but roughly following the same path. Okay, let's talk trade ideas in no particular order. KHC did report this morning, so that one's out of the way, and they've held up so far. So I can say this: the breakout's intact. If you are bullish, I haven't shared many long, side equity trade ideas lately. We've had commodities, other things, but KHC's earnings are out of the way, and nothing spectacular. It's about flat, but the breakout's still intact. I'm not going to add it as an official trade idea yet. I'll keep an eye on it, and we'll see what the markets do. But I just wanted to mention that one's out of the way. The other one, something stands out to me. I'm going to jump back over here to the futures real quick and show you dollar futures, which if you're a futures trader, nice little setup right here in DX. DX are the US dollar futures. You can also use UUP, which is a US dollar ETN. And I'm not a big currency trader, although I will sometimes. I'll trade DX, E7, the Euro futures, or whatever setting up. I always say if it has a ticker and I can buy or sell it with a few clicks of a mouse, I'll trade it. Whether it's Bitcoin, currency futures, you name it, doesn't matter. The charts work the same. You can see all the, I don't know why that line is there. You should have had an extended divergent low right there and there, but you can see wash, rinse, repeat, same kind of stuff I look for. Same kind of setup in the indexes. Now we have, here we had positive divergent low, and a rally. Here you had negative divergence. There's your divergence lines and a correction. Here you have right now It's a trade setup. This is divergence, and I always say divergence is not a buy or sell signal. What does that mean? Well, we're in a downtrend. Divergences can continue to build. Maybe the dollar DX goes down to the next level. Where you have a buy signal here is right here above a break of this trend line, and then you can see the potential targets right there. And if the divergences are confirmed, you can maybe get a trend reversal. Otherwise, we can inch our way down here to the next support level. So just one to keep on your radar. Why did I bring that up? Well, for two reasons: a pure play trade idea, but also gold. Gold tends to move inversely to the US dollar. I get this all the time. Any two asset classes with a correlation, whether it's positive or inverse, to their prices, meaning they go up and down together, or one goes up, the other goes down. There are times where those relationships disconnect for a while and don't play out. There's other variables that make the price of gold go up and down. So first and foremost, supply and demand, flight to safety, industrial applications. Gold it's a precious metal, it's jewelry. Collectors buy gold coins. It's used in all kinds of, like I said, industrial applications. So many different uses, but that can affect the supply and demand. But ultimately, it's very simple. Gold, at least the gold we're trading here in GC Gold Futures or GLD, the ETF, is priced in US dollars. Therefore, if the dollar drops by 10% in value, let's just say, over a period of time, well, it's going to take more dollars to buy an ounce of gold. So therefore, the falling dollar is bullish for gold prices. Likewise, if the dollar is strong and it's rallying and it goes up 10%, it will take fewer dollars to buy 1 ounce of gold. That is the simple reason why and again, I've shared it many times. Don't look at it over a period of week, 2 weeks. Pull a 10, 20, 30-year chart, overlay that with the US dollar and gold, and then you'll see that relationship, how it works over time. So where am I going? Well, I just wanted to update that. The gold's kind of holding up, but could come under pressure if that breaks out. Maybe, maybe not. It's a long-term trade idea. It's still an active trade on the site. Gold is in a bull market, as I mentioned. So I've seen and pointed out some of these bearish developments, bearish divergences, trendline breaks, but it's holding up, like I said, very well, which is to be expected because bearish chart patterns, bearish breakdowns tend to either not play out at all when an asset is in a strong bull market or the markets, whatever it is, or they play out but for a minimum smaller than expected move. For in this case, you had the on the 60-minute chart at GLD here, you had this bearish rising wedge pattern, negative divergence, everything was pointed out, and the measured target for the pattern is the widest part of the wedge right there. And you can see we didn't quite hit that. No, we went down, set up this little divergent low, and had a kickback rally. So this is so far bullish price action in gold. Oh, well, Randy, it's going sideways like the market. How do you call that bullish? Well, because it's correcting so far. We'll see what happens, but so far it's correcting in time and it's shrugging off, for the most part, these bearish technicals. And if it can correct in time more so in price, then that's bullish, meaning go sideways for a little while, work off the overbought conditions, work off the divergences, and then have another thrust up. So as with the last week or so, I've been saying I'm cautiously bullish on gold. If I didn't already own it, I wouldn't be buying it right now, especially with that potentially bullish setup in the US dollar. But it's a long-term trade for me, and it's also an official trade on the site, one that we're still, let's see. Trade targets are here. Our next target's up here, current final target at T4. We've already hit our first 3 targets, went long back here at that 139.12 level. And here's another case of a potential, there's a high-level bearish PPO crossover. But we had one here, it was a whipsaw, but then that one stuck. We had one here, and actually did play out for a correction. So, and there's one that we had one, but it played out for a minor correction. So we'll see. I point these things out. Again, there's some technical cross currents, but bigger picture is we're in a bull market, so maybe we pull back, maybe these divergences, bearish PPO crossover play out, and if anything much changes beyond that, as I've done many times, I may just pull the trade early. Haven't officially raised the stop, but I mentioned it should be. If you bought it back here or anywhere in between, at this point you don't want to let it go all the way back down to this suggested official stop. That stop should be set, at least lock in profits at T2 minimum at this point, if not up higher. by raising your stop is what I'm talking about. Okay, now we'll go through the trade ideas, my watch list of the official trade ideas on the site. Autodesk was stopped out, as I said. I contemplated and just doing a blanket suspend all stops on all trades this week because of the volatility. I think they probably clipped us, just like our sugar trade. We had a stop, 1-day stop raid, and that's what I think probably happened here. I suspect Autodesk will close back down below that stop, but it was stopped out, and I didn't change it ahead of time, so that one's officially stopped out. I'll have to post an update on the front page. But for those in it, I think it still looks good. Where's our targets? Right here. There's your targets. The only thing I've done different to this chart, added a potential trend line right here. It's not the best to find, but that's it. So that one officially stopped out. Berkshire still an active trade. That one's still profitable. There's an example of what some might consider a runaway market, but we're sniffing out the stocks that I think look to be probably already finished their run, like Berkshire. So it's nothing more to add to that. It's profitable, but still well below. This is a longer term trend trade, still well above the first and second price targets. Costco, same story. We're back at just a hair. We're 3 points on a 300-point security, so we're about 1% above our entry price, slightly underwater, but it still looks good for now, so nothing more to update there. Down today. DPZ, Domino's Pizza, that hit our first target yesterday. Again, I haven't posted an update. I'm behind on these trade ideas. First target was 139.46, so that's been hit. Yesterday we hit a low of, and you can see, remember, if you're new to the site, the official trades, you'll always see T1 equals, T2 equals. What I do is I adjust. This line is at 349.38, and so what I do is I'll put the price target a little bit above there because I don't want to miss a fill should the buyer step in a little bit early. So we hit a low yesterday of 349.09. So again, versus 349.38. And when you look at it, that's almost a perfect tag of the support level followed by a bounce, and that's why I list multiple targets. Some traders may want to actively trade, cover there, sidestep the give back. So far, that's been a give back. If you were, an active trader and you covered at T1. You could have reshorted here, after, bounced almost 6%. So you cover, even go long, game the bounce, and then get back in short, because I definitely think this one's going down, going to have another leg down soon. And that's how it works. So you can actually juice your returns by an additional 12, whatever, let's say 5%. You took a 5% bounce, that's a relatively small bounce off there. Went long, got the 5%, turned around, went back short now, and hold up for the next leg down to that second and third target there. So DPZ still looks good. Gold, I already covered gold. Still an active trade. LQD, like I said, not as optimistic of both of these targets being hit. Although I'm still leaving it on as an active trade because this is where the Fed is coming in and supporting. This is exactly what they said when they invoked emergency charters that were put in place back in the Great Depression and only used then, and I think back in 2008. They can come in now and buy junk bonds, investment grade bonds, even ETFs, and I'm sure this is one of the ones they're buying. So they'll support it, but however, I believe they're not going to bring LQD up to all-time highs. LQD, if we had a true price discovery right now and the Fed wasn't in the market, LQD would be way, way lower. It would have broke. The corporate the bond market would have broken and would be way down. So we're just going to sit tight for this one for now and look for at least a backfill of the gap, and then I just at some point may close it out early and move on, just so we're not in a dead money trade because the Fed's going to support that. But I do think it's going to go down from here, and so far we adverted. We did the same thing. We suspended the stop just that one day after the announcement that they were going to come in. It created a short squeeze, order imbalances, and we've been drifting lower since. NVIDIA, let's see, where are our parameters on this trade? What did we do? Is this a weekly? Yes, it is on a weekly. Not sure where the stop is. I might have added that line in with the drawing tools on the screenshot, so I'll look at that. But still looks good to me. I'll tell you whether I don't know where the stop was. Again, I'll have to revisit that. But there it is, a breakdown and a back test. Big divergent high right there. And a lot of downside potential, in my opinion, on this one. You know, all the way down here to ultimately, and this might take 6, 8, 12 months or more to get there, but about 86% downside. I'm sure there's a few chuckles right now in the audience, but again, I've spent a lot of time talking about the previous cycles in the semiconductor index and this particular stock, and that would just be a run-of-the-mill correction. And actually, this time around, this is like I said, the bigger the bull, the bigger the bubble was inflated by the Fed with easy money policies over the last 10 years, the bigger the next cycle is going to be. I have little doubt about that. So anyways, take it as you want or don't take it. And we'll move on to the next one here. PALL, Palladium. Again, I have very high expectations for our short trade, low price expectations for Palladium. I've covered it in many videos in the past. We'll most likely add additional targets here. So far, it's playing out. We already hit our first target, and we're just kind of stalling out here. It's holding up because the market's holding up. It's an economic play. Everybody is somehow assuming because the Fed has come in and artificially put a backstop into the financial markets, that somehow Ford and General Motors are still building as many cars as they were 6 months ago, which is not the case, as we all know. Palladium, its biggest use is on emissions control. Was there a shortage of palladium? Yes, that led it to one of the strongest bull markets in history. But I've covered this one just like with NVIDIA. I've done a detailed video of long-term chart of palladium prices and showing you the boom and the bust and the downside once it puts in a top, which by most accounts this looks like a major top. Technicals look as bearish as they could be. That PPO rejected there at the zero line like I talked about, and that's it. So not much more to add. This trade looks good. We're well comfortably below the stop. It looks like first leg down, counter trend rally, and headed down to the next two targets soon, I believe. We'll see. And two more. Sugar was stopped out there. That's the one I talked about. This is where you get these it's a stop rate, a stop hit. We had a stop right there, as I mentioned the other day, and then snap right back above, and then went on to break out above this bullish falling wedge. I mentioned it just yesterday or the day before. Is looking good. This is sugar futures right there. SB also broke out, and now it's taken out that 10-15 level there. Looks like yeah, perfect back test too. So it looks good up here. So sugar I still like. As I always say, official, unofficial. Use your own stops, but looks good. And SPY, already covered SPY. And Verizon, where are we at on Verizon? This one I think is also a longer term short trade. Well below the stop. It's holding up. It's down today, and it's not going anywhere. We shorted, back tested this trend line, and so far was rejected because it's a top component of, or a major component of the S&P 500. I believe the Nasdaq as well. It's not going to go down much until the market turns down, but looks good as of now. And that's it, guys. Those are all official trade ideas, a couple of the unofficial trade ideas, and kind of a some random thoughts and fundamental things to think about with the market. And again, it all comes back to right now, because yeah, sure, I might be right or wrong on those fundamental thoughts on where the market's headed, but I can tell you this is the primary focus right here. Are all these purple or magenta trend lines that I put there. There's QQQ dancing on it right now, and SPY. Which again, those are the most important to the indexes, but you want to watch those big sectors as well. SPY also dancing right on trendline support. So Apple and Amazon have the potential to make or break these levels here tonight and into tomorrow. Hopefully we'll have some kind of definitive resolution by the close tomorrow. If not, maybe first thing Monday. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.